the best of Money Matters.
Market View on Money FM 89.3.
That's right, you're listening to Money FM 89.3. Time now for Market View with me, Chua Tian Tian, where we take a look at how the Singapore stock market closed for the day, the biggest movers, sectors and companies to watch. But as always, a quick recap of how we started. Well, Singapore shares began the day trading in the green as overseas markets closed a holiday-shortened week, mixed with anticipation for the incoming Trump administration. In early trade, the Straits Times Index was up 0.5% at 3,819 points after some 58.5 million securities changed hands in the broader market. Now let's take you through the closing numbers. The STI closed up 0.53% at 3,821 points. In terms of value turnover, we are looking at 854 million Sing dollars. Gainers outnumbered losers, 263 versus 258. Top advances for today, we've got the trio of local banks, DBS, OCBC and UOB. And top decliners for today, we've got here Sunta EcoCity, UOA, Yenlot. Now, in terms of companies to watch, we do have Mapletree Logistics Trust. After the REIT manager said it is divesting a property in Malaysia for 31.5 million ringgit. That rounds up to about 9.6 million Sing dollars or 31.3% above value. Now, elsewhere from interest in the Johor-Singapore Special Economic Zone to Asian currencies falling to a two-decade low against the US dollar, more local and international headlines remain in focus. Also on deck, what to expect ahead of the release of November's US JOLTS jobs report tomorrow night. Now, a lot of things to watch, and joining me on a Monday, as always, is Chin Hui Leong, co-founder of The Smart Investor. Chin, welcome.
Hi, Tian. Glad to be back.
Yeah, and Happy New Year to you and your family as well. And Chin, let's start with the Singapore stock market as usual. How did the STI fare today? Any surprises when it comes down to the companies to watch? I know we've got CSE Global on our list. The tech solutions provider proposed to divest its industrial property in the US. Any thoughts?
Yep. So I'll just speak briefly on the stock market as a whole. What I did notice is the three bank stock prices are up, and so are the REITs. So I know that we're going to talk about interest rates later. I just wanted to mention this because it doesn't seem to be any noticeable reaction, given interest rates are usually good for banks, higher interest rates, but not so good for REITs. But today we see both parties going up. The REITs, all but one of them have gone up. Now, moving to CSE Global, I think that there's two major points I want to make. Number one, the sale is for industrial property in Texas, and the sale price is $29.3 million US dollars, right? They expect to record a gain of just under 12 million Singapore dollars, and this would be a one-time gain. So to give you some perspective, or listeners some perspective, for the first half of 24, right, they made roughly about 15 million in profit. So the 12 million is a very nice bump, but it's one time, right? The more interesting part is the second point, which I want to make. They're looking to reinvest into larger facilities, right? And this is very interesting because around 64% of their revenue from the first half is actually from the Americas, and roughly about 42% of their EBIT is from also from the Americas. So they are looking to expand faster, and that's why they're selling this property.
Okay. Now, Chin, let's zoom in on some of the other counters to watch. You talked about REITs earlier. Let's take a look at Mapletree Logistics Trust. The REIT manager said it is divesting a property in Malaysia for 31.5 million ringgit, about 9.6 million Sing dollars, or 31.3% above value. Now, we understand that there won't be any material impact on net asset value and net property income for this current financial year. So how significant then is the move for Mapletree Logistics Trust?
Yeah, so I think you've more or less answered the question. Because just to give listeners some perspective, right, the Mapletree Logistics Trust has 186 properties. So this is just one of that 186. And their total asset value is 13.4 billion, right? So that amount of 9.6 million is really very small in the whole context. But I'll just make two very quick points. Number one, I think they sold it at a very nice premium because they actually purchased this at 17.2 million. right, based on what I could find out. And secondly, they are actually investing in redeveloping their Malaysian facilities. The property being sold is called Subang 2, but there's Subang 3 and 4, which is being redeveloped. And they're looking to, they actually bought some land next to these two properties, and they're investing somewhere in the region of 173 million overall. But as you said from the start, this is not a significant portion. Malaysia as a whole is only about less than 6% of its assets under management, so it's not a very significant deal.
And from REITs, let's talk about banks and interest rates. Chin, as you teased earlier, we are kicking off the first full week of 2025, and analysts said Singapore banks, they'll likely post earnings growth this year, led by higher for longer rates and a strong wealth management business. How aligned are you with this, and what are the key levels to watch then for the trio of local banks?
Yep. So banks make money through two ways, right? Number one is through loans that's captured in their net interest income. And for that, it's more sensitive to the interest rates. Now, this portion of the revenue, the loans which they make, has been doing all the heavy lifting for the last 2 years because interest rates have been going up. They've been able to earn more margins of each loan they give out. And because of that, they've gained a lot from the net interest income, right? But I think it's time to pass over the baton to the non-net interest income, right? Where this is where things like wealth management fees, credit card fees, these are the other stream of revenue which banks make. And if you look at the sort of forecast from DBS and UOB, DBS is expecting a high single-digit growth for this portion of revenue, and UOB is expecting a double-digit growth for this portion of revenue. So I think in general, all eyes will be on how much the interest income, this is where the loan business is from, will change. DBS is expecting it to be flat. And then how much growth or how much heavy lifting can the non-net interest income do by growing either in the high single digits or double digits.
I see. And it appears that, Chin, we can't run away from talking about Singpost, even though we have been discussing the stock or the company for weeks and weeks on end now. Singpost today cautioned that the sale of its Aussie assets is not a done deal.
Right.
So if we were to turn back time, on Friday, there's a media report out that cited Maybank saying that Singpost could offer a potentially significant special dividend after it completes the planned sale of two business units. How would you read into the latest developments? How far would that throw in more volatilities for the counter?
I have to say one thing first. You can't really fault Maybank for mentioning or highlighting the potential for a special dividend, because that's exactly what Singpost highlighted as part of its 2nd December announcement, right? This was before all the drama which is happening in the management level, right? So this was something which Singpost specifically highlighted, that they were considering a special dividend without anyone prompting. So they announced they're selling their Australian business, and they said that they were going to consider a special dividend. So you cannot fault Maybank for pointing it out, right? And secondly, I think that we are receiving more information, right? It's important to listen to both sides. But the problem is now there's discrepancy between both parties, right? Because after the Singpost on 29th of December, they've released a new announcement, and they talked about discrepancies of what the three executives said and what they found out. The executives have come out and said that, a lot of these shipments, they are to areas of conflict, and that's why that was done. The non-delivery was not done or attempted at all. And secondly, they were only asked for their views initially and alerted on the discrepancies only after the forensic service provider was engaged, right? Now, Singpost is disputing this version because they're saying they were provided that information. But I think the bigger deal here is there's an overlap between this investigation period, and you can tell that there's this he said, she said sort of situation. But it does tell you there's an environment of mistrust throughout this period where the decision on the sale of the Australian property was done, which is why I think there will be a lot of questions when the EGM comes in February, I believe.
Okay, I see. Now, if you're just tuning in, we're now in conversation with Chin Hui Leong, co-founder of the Smart Investor. Now, Chin, let's talk about the upcoming Johor-Singapore Special Economic Zone, or the SEZ. The SEZ is not only drawing interest from companies in Singapore, but also plenty of attention from Chinese businesses looking to expand their operations. Question, though, what would interest from Chinese companies in the Special Economic Zone mean for Singapore, especially when we look at things from a Trump 2.0 context?
Yeah, so maybe a bit of context. I've visited more than 50 factories, anywhere from Japan, Korea, China. This was in my earliest days, right? Different parts of China, different parts of India, Thailand, Philippines, and Indonesia, and even Malaysia, right? And there's something very comical which I notice whenever I visit all these countries, right? Every single country will claim that they are the center of Asia, and they are the Asian hub for Asia, right? And if you even walk to the Economic Development Board, EDB, in Singapore, right? There's this very huge map there which tells you in bold letters that there's only a maximum 7 hours to reach any country within Asia, right? Which tells you they want to position themselves as the Asian hub again. But I think what's interesting is, based on my own anecdotal experiences, that they do walk the talk for the case of EDB, because there are a lot of parts which are, for example, manufactured in Thailand but shipped via Singapore, right? And I think if you look at the connectivity which Singapore offers, just look at the amount of flights going every day to Europe, for example. This is not always true for other countries or other airports. And there's also the factor of the free trade agreements, which Singapore has favorable free trade agreements with the US, for example, which provides this sort of nice little, call it combo of lower manufacturing costs in Malaysia and better connectivity and free trade agreements in Singapore. So I think that China is not the only one who's interested. I would imagine a lot more other countries will be interested.
How far do you think, though, a curious question and an impromptu one over here, Chin, how far do you think the Johor-Singapore Special Economic Zone will add in vibrancy to counters on the SGX, particularly those focused on infrastructure or data centers, so to speak?
Yeah, so I think as I was born in Malaysia, and one thing I've always sort of be more cautious about is to wait until things actually happen.
Okay.
And there's this saying that seeing is believing. Until I see it really happen, then I'll believe it.
Okay, so we'll wait for it to happen first and see how it goes then. Across the region, Chin, Asian equities, or Asian currencies rather, fell to a 2-decade low as the US dollar remains buoyed by robust US growth and President-elect Donald Trump's tariff hike vows. Now, I believe that if we look at the Bloomberg Asia Dollar Index, that slipped to as low as 89.0409 today, the lowest in data going back to 2006. How concerned are you about the weakening of Asian currencies against the greenback?
Yeah, so the interesting thing is, if you go back a decade ago, you'll find articles sort of complaining and warning against the weak US dollar. And today we have a totally different situation, right? So it does tell you a lot about the cycles which currencies go through, right? Now, in my simple mind, a stronger US dollar is good for exports, because in simple terms, for example, if you're a Korean manufacturer and you earn $1 in US dollar revenue, you're able to convert it into more Korean won and be able to cover more expenses with that stronger, because $1 US provides you more Korean won. Now, the other benefit, of course, is tourism. I see a lot of Singaporeans now going to Japan, for example, and I think that that is another benefit, medical tourism as well, which a strong US dollar will benefit the Asian countries. But of course, the wind blows both ways, right? Yeah. It will be not so good if, for example, your Korean, you earn less Korean won and will have less money to actually pay your expenses if the US dollar were to weaken, right? And the bigger point here, I think, is about the pace of change, because if there's a change of, say, $1 US to 1,000 Korean won, and it changes to 900 won, for example, a drop of 10% within a week, then that will be a major impact, because I cannot imagine how a person is able to manage, 10% less takings within a week, right? So I think in the case of Singapore, these changes tend to be more gradual rather than sudden. So I'll be more concerned about the pace of change rather than the magnitude of change itself.
And finally, let's very quickly take a look at the U.S. before we let you go, Chin. We have the November US JOLTS job openings report due tomorrow night. We've also got minutes from the Fed's latest meeting due Thursday morning, and of course, all eyes on non-farm payrolls on Friday. But really, how would you prioritize what to watch this week?
Yeah, I think job openings are not that interesting to me because you can have high job openings and high unemployment at the same time. A great financial crisis showed us that. But I wanted to talk a bit more about the interest rates because there's a quote by Morgan Housel, which said that read last year's market predictions and you'll never again take this year's predictions seriously. And he's absolutely right because last year they were predicting 1.5 percentage points in rate cut. And we ended up with 1%. They would predict 73% of traders were expecting a cut in March, and we only had that in September. Goldman Sachs said there was only going to be 5 cuts or interest rates cuts in 2024, and we ended up with 3 cuts, right? So in all 3 counts, the size, when the cut was going to happen, and the number of cuts, it all disappointed all of the forecasters, and yet the stock market actually went up way more than any of these analysts or economists predicted, right? 21% on average higher than the average of the predictions last year. So as Morgan Housel said, he's absolutely right. You'll never take this year's predictions seriously again after reading last year's.
I see. Lots to watch indeed. Thanks for the insights as always, Chin. That was Chin Hui Leong, co-founder at The Smart Investor. Thank you so much for joining us today.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance.